What if your paycheck is getting bigger, but your wealth isn't growing as fast as you'd expect? It seems strange, doesn't it? More income should translate into more wealth, more savings, and less stress, right? But for many people, despite earning more, their financial situation remains stuck. Money flows in, money flows out, and at the end of the month, the savings don't add up. Today, we're going to uncover the top 5 financial mistakes that slow down wealth growth. These are mistakes that many people, no matter their income level, make every day. But the good news is that once you recognize these mistakes, you can start turning things around. Let's dive in. 1. Lifestyle creep. The silent wealth drain. Have you ever gotten a raise and thought, this extra cash means it's time to treat myself? You're not alone. This is a common financial pitfall known as lifestyle creep. Lifestyle creep happens when your spending increases as your income rises. At first, it seems harmless. A bigger paycheck means you can enjoy a few more luxuries, like a nicer car or a bigger apartment. But the issue starts when your expenses rise faster than your ability to save or invest. For instance, imagine you get a $500 raise at work. Instead of using that extra money to boost your savings, you decide to upgrade your phone, take a fancier vacation, or subscribe to more services. Now, your new income feels stretched thin because you're spending more, not saving more. Over time, this pattern repeats itself, and instead of building wealth, you're just increasing your living costs. As this habit continues, it can be hard to stop, especially since the upgrades often feel like rewards for your hard work. But you must ask yourself if these purchases are adding value to your life in the long run, or if they're simply inflating your standard of living without a real improvement in your financial situation. And with inflation eating away at your purchasing power, this habit becomes even more dangerous. Small increases in spending can significantly impact your ability to build wealth, especially if you're not keeping an eye on recurring costs like higher rent, car payments, or subscriptions. The solution is to pause before upgrading your lifestyle after a raise. Don't let your spending automatically rise with your income. Instead, save or invest part of the increase first. Review your monthly expenses to see where you can trim the fat. Many people don't realize how much they're spending on things they don't really need. And finally, stop comparing your lifestyle to others. Social media often shows a polished version of life, but it doesn't reflect the financial struggles behind the scenes. Focus on your long-term goals, not temporary upgrades. 2. The high cost of debt. Debt can be a powerful tool when used wisely, but when it's mismanaged, it can become a huge roadblock to wealth growth. With interest rates remaining high, consumer debt can drag down your finances more than ever. When you only make minimum payments on high-interest credit cards or loans, the balance doesn't decrease quickly enough. Instead, you're paying more in interest, which reduces your future earnings and savings potential. For example, imagine you owe $5,000 on a credit card with an interest rate of 20%. If you're only making the minimum payments, it could take years to pay off the debt, and during that time, the interest keeps piling up. Meanwhile, your money could have been growing through investments, but instead, it's stuck paying off interest. The problem with high-interest debt is that it traps your cash flow. The more money that goes toward paying interest, the less you have available to invest, save, or put toward other financial goals. It becomes a cycle that's hard to escape unless you actively focus on reducing your debt burden. To fix this, start by paying off high-interest debt first. Consider using the debt snowball method, where you tackle the smallest debt first, or the debt avalanche method, where you focus on the debt with the highest interest rate. Reduce new debt accumulation by avoiding unnecessary purchases and using cash instead of credit whenever possible. Every extra dollar you pay toward debt is one step closer to freeing up money for saving and investing. 3. Chasing market hype. It's easy to get swept up in the excitement when everyone on social media is talking about the next big investment opportunity, whether it's a hot stock, cryptocurrency, or the latest next big thing in tech. But let's be honest, chasing market hype based on emotions or fear of missing out FOMO can be a huge mistake. With the rise of AI-driven hype cycles and social media influencers touting hot trends, it's tempting to jump in on what everyone else is buying. But this kind of impulsive behavior rarely leads to success. By the time everyone is talking about a stock, it might already be overpriced, and the market could be due for a correction. The problem is that investing based on hype doesn't consider your individual financial goals or risk tolerance. You might be buying into a trend that works for others, but it might not align with your long-term plan. Worse yet, the volatility that comes with chasing hot stocks or cryptocurrencies can lead to significant losses when the bubble bursts. The solution is to stick to your investment plan and avoid making impulsive decisions based on market noise. Successful investing is about patience, not quick wins. Diversify your investments to avoid putting all your money into one asset or sector. If all your investments are in a few high-tech stocks, you're leaving your wealth exposed to unnecessary risk. And avoid selling in a panic during market corrections. The market moves in cycles, and short-term drops don't necessarily mean you should pull out. 4. Letting cash sit idle. Cash might feel safe, but when you leave it sitting in your savings account without putting it to work, you're letting it lose value over time due to inflation. With inflation rates still high, the purchasing power of your cash can decrease significantly if you're not investing it properly. Sure, you need a cash buffer for emergencies, but beyond that, cash doesn't build wealth. If you're holding too much cash and not investing, you're essentially losing money. For instance, if you have $10,000 in a savings account earning just 1% interest, but inflation is at 5%, your money is actually losing 4% of its value each year. The danger of holding too much cash is that it can give you a false sense of security. While it's important to have liquidity for emergencies, excessive cash can hinder your ability to grow your wealth in the long run. Cash is safe in the short term, but over time, it doesn't keep up with inflation, meaning your money is slowly losing its value. The solution is to keep 3 to 6 months worth of expenses in a liquid emergency fund, but put your longer-term savings and investments into assets that can outpace inflation, such as stocks, bonds, or real estate. Don't let cash sit idle for too long. Set a clear goal for your savings and invest it in diversified assets that match your risk tolerance and financial objectives. 5. Ignoring the need for protection. Protection might not be the most exciting part of financial planning, but it is essential. Unexpected events like medical emergencies, accidents, or the loss of income can completely derail years of financial progress if you don't have proper protection in place. Think about it. If something happened to your main income earner, or if a medical emergency wiped out your savings, how would your family manage? Without the right insurance, health coverage, or other protective measures, you might be forced to sell investments at a loss or take on more debt to cover urgent costs. The solution is to ensure you have essential insurance, like life insurance, health insurance, or disability insurance. These aren't expenses, they're protections for your future. Review your insurance policies regularly to ensure they match your current needs and life stage. Make sure you have an estate plan in place, including a will and power of attorney, to protect your assets in case of an emergency. And there you have it, top 5 financial mistakes that slow down wealth growth. Remember, it's not about earning more, it's about using what you earn wisely. A strong financial future is built on discipline, planning, and consistency. Which of these pitfalls do you think is the most dangerous to your wealth growth? Let me know in the comments. If you found this video helpful, don't forget to hit that like button, share it with someone who needs to hear this, and subscribe for more practical tips on building a stronger financial future. Thanks for watching, and I'll see you in the next video.